This week's theme on the Retirement Quick Tips podcast is the mid-year 2024 economic and market update. Today, I'm talking about investment opportunities that exist in this current market. Honestly, it hasn't really changed that much over the last 6, 9, 12 months. If you want to participate in stock market returns, you don't want to completely shun the S&P 500, the tech giants. I talked earlier this week about some of the risks in there. So you do want to be careful about over-concentrating your portfolio in this area, especially in this unusual market that we're in. So you have value and dividend growing stocks. These are pockets of the market, large pockets of the stock market, very much unloved for years, but they offer quality, they offer stability, they offer income. It's ideal for investors nearing or in retirement. And they've been out of favor for so long that this regression to the mean is inevitable. So what I mean by that is, you might have a certain sector of the economy that outperforms for years and years and years. This happened with real estate basically for much of the last 15 years, where like every year it's perennially at or near the top when you stack it up against other sectors of the market. But it can't continue forever, because if it does, it's going to overtake the entire economy and be all that there is. And so you have what's called this regression to the mean, where things will get out of balance, but then things will revert back to what is normal. This happens not just in the stock market or in the economy, but in life in general. There's always this sort of regression back to the mean, and things that are out of balance get back in balance. And so you have value stocks, dividend stocks that have been out of favor and unloved for so long, years and years and years. That valuations are so attractive right now compared to a lot of the bigger tech names and the broader market in general. So I've been pounding my fist about dividend growing stocks, especially. It is one of my favorites. It's a core holding with my own client portfolios. I personally invest in dividend stocks. I love them. They're very compelling to own, especially for long-term oriented investors, but they've been pretty much unloved and ignored for most of the last decade or more. We'll see how things shake out, especially with AI, but it's inevitable that there will be a regression to the mean. I just don't know when that will happen. Okay, another area that I think is interesting is real estate. Now, I don't mean investing in buying a rental property or commercial property. For the average investor, much of that is out of reach. But you can buy real estate investment trusts, and they trade like stocks, and you buy them just like you would a regular stock. And you can buy a broadly diversified one, and that's in different pockets of the real estate market. But real estate is interesting because it has been hurt so much by the higher interest rate environment that we're in, that I think there are some opportunities right now, especially in REITs, as well as some specific industries as it relates to the presidential election. So I remember if you look back in 2020 and what happened with gun sales and the stocks of some of those publicly traded companies that manufacture firearms, they went crazy because people were worried that if Bernie Sanders or Biden were elected, they wouldn't be able to own guns anymore. And also there's a lot of craziness happening in 2020 anyways. So a lot of people went out, and many for the first time bought firearms. So that's just one example of like very specific pockets that are related to the presidential election, that you have sort of unique opportunities that come every few years. The tricky thing though is that those are difficult to predict. You could be very early in investing in REITs or pockets of the real estate market as well. And so it is more speculative in nature. Best to stay away or even invest just a smaller portion in your portfolio in this area if you're interested in more of a speculative investment or having a little fun. I call it a little mad money. As for investing in bonds, I think it's a great time to lock in higher interest rates. So with my own clients, I've been building a bond ladder where, we buy a 1 year, 2 year, 3 year, 4 year, 5 year bonds. You can get a better rate right now on, say, a 6 month or a 1 year bond than you can on a 4 or 5 year bond. But I would rather have something that was slightly less, but, maybe still paying 4.5% to 5%. That wasn't going to change for 5 years. So the bottom line here is that now, if you are a bond investor, if you have bonds, now is a great time to lock in. I wouldn't go really far out. Like I use the example of going out about 5 years. I'm hesitant to go out much further than that. I will, but only in certain circumstances and for specific reasons. So you don't want to go out too far, because if interest rates go up, you can get burned by going out too far. So you want to be careful about that. But it is a very, very compelling time. And with any guidance that I would provide to clients, the strongest suggestion I have right now is to not sit in short-term money markets or 3-6 month CDs, because the opportunities that exist in some of the longer bonds or intermediate bonds, like 4, 5, 6 year bonds right now, that they may not be around in 6 months, depending on what happens with interest rates. So rates may go higher, yes, but they're likely not to go much higher. So bottom line is, there is a great time to lock in rates and extend your maturities and not be sitting in money markets or 3-6 month CDs, but lock in longer maturities, 4 or 5 years, and collect that income stream for the next several years. The bottom line here is some of the best opportunities exist in the strangest of markets, and this is definitely one of those strange market environments. That's it for today. Thank you so much for listening. My name is Ashley Michike, and this is the Retirement Quick Tips Podcast.